Hey everyone, welcome back to this week's Teaching Thursdays. We got another great episode. We're finally at options. We're going to dibble on a topic that everyone has been asking about. We've covered stocks, bonds, mutual funds, ETFs, dividends, as you can see from our Healthy Investor t-shirt, because we're trying to make you a healthy investor and make you knowledgeable upon everything that we can for the stock market so you can be a confident investor and make sound decisions. So today we're actually going to talk about options. Now, options is simply just that. You have an option to buy stock. You have rights to buy the stock. You're not obligated to. And so the way the options work is you're going to have a writer, which is going to be your seller of the contract. Then you're going to have the contract itself, which normally is about 100 shares of the stock. And then you're going to have a holder, which is going to be your buyer. So the way it works is the seller, who let's say is Johnny, the seller has 100 shares of, let's say, Apple stock. And let's say Apple stock currently is at $100 per share. $100 per share. So Johnny can say, I will sell a contract, which is rights to buy 100 shares of Apple stock to whoever wants to buy, and let's say that's me. So, we got Johnny, and we got me, Eric. So, the way that Johnny is going to play this is, because there's going to be two different angles here. As a buyer, you're thinking one thing. As a seller, you're thinking another thing. So, Johnny is going to sell this contract, but Johnny thinks that the price is going to come down. So, what's going to happen is, he's going to sell a contract at $90 per share. That's going to be your strike price. Okay? So the strike price. The strike price is simply the agreed upon price between the writer and the holder, or the seller and the buyer, for the buyer to purchase from the seller. So Johnny is telling Eric, I will sell you 100 shares of Apple stock that's currently trading at $100 a share for $90 a share. But you're buying the rights. So that means that Johnny is selling a contract, which is a premium. So Johnny says, I will sell this contract to Eric for $50. So that means that I'm buying a contract from Johnny for $50 to have rights to buy the stock at $90 a share, which is a 10% discount. Now, we're talking about 100 shares here, so we're $10 less. That's a $1,000 discount that I'm paying $50 for. So in essence, I'm saving $950 by doing this transaction. And that's the way the options are working. But Johnny is going to sell it at this strike price for the premium. Now, he thinks that the stock is going to go down. And let's say I think that the stock is going to go up. So Johnny sells a call at $90 a share, and let's say, and we'll get into what a call is, and I think that the stock is going to go up to $120 a share. So that means that if the stock is currently at 100, I buy at 90, but the stock goes up to 120, I just made $30 per share, or my contract price is probably going to go up as well, because the contract price reflects the movement of the stock. But Johnny thinks that the stock is going to come down. That's why he's trying to sell it to someone as if the stock is going to go up. Now, in the event, let's say that the stock actually does go up, well then this $50 price that I just paid, it might actually go up to $500. Let's just use that as an example. So that means I just made $450 on this contract without actually owning the stock. That's how option trading happens. And so I can actually sell this contract to somebody else for $500, make my $450 profit, and now Johnny has to deal with somebody else, and I'm good to go. But let's say that the stock price actually goes down as Johnny was expecting, but I thought it was going to go up. So let's say the stock price now is at $80 a share. That means that I have contracts that are good to buy this stock for $90 a share, but the stock is only trading at $80 a share. What does that mean? That in the open market, I can buy the stock for less than what my contract says. So that $50 is probably going to, boom, drop. It's probably going to be worth like $25 now. So I lost money in my contract price. And what happens is, let's say you have a strike price, and then you're going to have an expiration date. Okay? So expiration date. So if Johnny and myself agree that this stock, the expiration is going to be July 31st, and let's say all this stuff transpires during that time, and we get to July 31st, and the stock is at $80 a share, I'm going to forfeit. I'm not going to buy the stocks from the contract because I'd be wasting money. But I forego the $50 that I paid, and now Johnny just made 50 bucks, and I lost 50 bucks. So in the sense of a writer for options, that's how you're looking to make money when you actually own the stock. But if you don't own the stock, you're looking to make money by the fluctuation in the stock. And that's where the call and put come from. A call simply means that you expect the stock price to go up, and a put simply means that you expect the stock price to go down. So let's say that Johnny made this same contract to sell to me, but instead of me buying a call contract at $90 a share, I bought a put contract at $90 a share. That means that I'm going to make money from the stock actually decreasing in price, because what happens is a put simply means that you're buying the stock with effort that the stock is going to go down. So if you have rights to buy the stock at $100 a share and the stock is now trading at $80 a share, you actually make money on the put. Don't ask me why, that's just the way it works. So now if I buy an option contract from Johnny that's a put contract instead of a call contract, that means if the stock is now at $80 a share and I have a put worth $90 a share, my premium that I paid, $50, is going to go up to that $500. Now we're just using arbitrary numbers here. These premium amounts can go up, can go down to whatever it is, but I will make money. But however, if the stock actually goes up to $120 and I have a put at $90 and it went up, then I'm probably going to be in the same situation before where I actually lose money and Johnny is going to make money on it. So that's pretty much how options work. As we said, you have your seller, you're going to have your buyer, and then you're going to have your contract. Now, like I said, most contracts are going to be 100 shares. The main thing to take away from options is you have rights to buy stock, but you're not obligated to buy the stock. You don't have to. Another thing to consider is that you have a writer who is someone is selling them. That means that this person owns at least 100 shares of whatever that stock is in the contract. And then you have a holder, which is someone that is buying those rights to those shares. So the buyer is buying the rights to the 100 shares that the seller owns. The seller is obligated to sell those shares to the buyer if the buyer exercises their option to buy the stock. But the buyer is not obligated. That's the catch. That's the tricky part here. If you want to sell it, people make money as sellers because they're making money off of the premium. People make money as buyers because they're looking to buy money. They're looking to flip it. And what happens is the big key to know with options is leverage. If you think about it, we mentioned how those Apple shares were worth what, $10,000? It was 100 shares, and it was $100 per share. That was worth $10,000, right? But you bought rights to buy those 100 shares for only 50 bucks. That's called leverage, because now you only paid $50 for $10,000 worth of something, and now if that $10,000 turns into $15,000 of a value, that $50 you paid might actually be worth $500 now, and you can sell that and make the flip. Definitely check out our In the Black Starter Pack, because we give a great example of breaking down of how options contract work and comparing to buying a home. A lot of you are probably pretty familiar with real estate, and there's something known as a good faith fee. So definitely get our In the Black Starter Pack so you can see that example, and it really breaks it down clearly how an option is related to that and how people really, really make money. People always ask about options because options are a way to make decent money, make really good money with a little amount of investment. Only thing is that options are very volatile. They fluctuate a lot more than the stock price. So if the stock price changes by $5 up and down, that might change the option price by $50 up and down. So that's just one thing to consider, because just like you can make a lot of money, you can lose a lot of money. But if you focus and know what you're doing, then you can make a lot of money in options and very quickly. I mean, these changes in price can change within 30 minutes. They can change within 3 days or 30 days. It just depends. And you can buy options that expire a month out. They can expire a year out. They can expire 3 days out. That's how people try to make these quick flips. That's just one thing to consider. Stay tuned. We're going to look to have a video in the future on a couple strategies. There's things called strangles, straddles, iron condors, as well as options are a way to hedge your bet. So let's say if you own a stock and the stock price, you don't want to sell it because you're in it for the long term, but the stock price is going down. You can actually buy option puts and make money while the stock price is going down and still hold the money that you have for the long-term investment of the stock that you have. And once you make the money on the puts and the stock is going back up, you sell those puts, take your cash, and now you're making money again on the stock going back up. So that's a brief interview on options. We hope it was great for you, and stay tuned for some more parts to it because options have a lot of options.